The stock of the day is brought to you by IG, Australia's #1 CFD provider. With over 17,000 markets and extended trading hours, turn US earnings season volatility into opportunity. Get started at IG.com.
Stock of the day is Ansell. The medical glove and equipment manufacturer says it will fully offset tariff increases through pricing, as it expects a major hit to its US imports. It generates around 43% of its revenue from the US and manufactures the majority of its protective equipment in Malaysia, Sri Lanka and Thailand, all countries that have been hit hard. Ansell has reaffirmed its FY25 guidance, but has not guided for FY26, with a range for adjusted earnings per share between 118 and 128 US cents a share. The stock was initially sold off heavily on that tariff announcement. It is actually in the green in today's trade. Kai, how have you seen the impact here for Ansell?
Yes, I think this is exactly what we're talking about, right? So basically a big portion of their revenue segment, 43%, is in the US, but their manufacturing base is in Asia. And the heaviest tariffs are in Vietnam, Cambodia, some of the East Asian countries, Southeast Asian countries. So it massively affects that. But I think what you were seeing here is basically Ansell passing on that increase in price to the end US customer. So it's I think the US customer just has a short end of the stick. But for Ansell, it's good. I mean, they are passing on the cost. They're going to be consistent with their guidance in terms of their earnings. So I guess the question mark would be will demand drop for consumers? It's yet to be seen, but I guess we'll see that play out.
All right. So what do you do with it if you're there?
I think it's for Ansell, it's fine. It's fairly inelastic in terms of the products that they produce. It's protection gear, medical protection. It's things that you need. So I think this demand is fairly inelastic and it will still be there. So they're just going to take the price increase.
All right. So I'm taking that as a whole then from you. Okay. Mark?
Ansell has been a pretty poor performer for a long time. And if you look at their earnings, at the moment, we're showing them, if you invest in it now, you should lose about 6% a year over the next 5 years. And the reason is their earnings per share are negative. The growth rate's negative 2.3%. The sales are growing at 1.3%. This is over the last 6 years. And if you look at their earnings, they peaked in 2021 at $2.54 a share. In the last report, they were $1.17. So, and that has been a slow, steady decline since 21, which was their high. And the return on equity is now 6%, return on capital 4%. These are all really, really poor numbers. So there's nothing in that before we even talk about tariffs that would make me want to hold Ansell. I wouldn't buy it and I wouldn't hold it. As far as I'm concerned, it's a losing business. So the tariffs aren't going to help. So that doesn't improve it. It just makes whatever that situation I was talking about look worse. So for me, it's a sell.
Yep. Okay. Well, that's a negative outlook then from Mark. Kai, willing to hang on. That is our stock of the day, Ansell.
The stock of the day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.